Hey Bowtie Nation, Joseph Hogue with your weekly stock market update coming at you Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. But Nation, stocks just hit new all-time highs and that's got investors getting nervous, asking if we are in a stock market bubble. Here is what they're missing though. Even at these highs, stocks haven't been this cheap in years. I'm going to show you why valuations have flipped the script on this bull market, why you need to keep riding this higher, along with updates ahead of a huge earnings week for Advanced Micro Devices, ticker AMD, Arista Networks, ANET, Super Microcomputer, SMCI, Symbotic, ticker SYM, and SoundHound AI, ticker SOUN. First, to show you how cheap stocks actually are. Nation, usually when the stock market reaches new highs, it brings fears of a bubble and stock valuations that are so stretched investors are on edge to take profits. When stocks were moving higher before their most recent crash, the S&P 500 doubled post-pandemic to 4780 by October 2021. But earnings, the very core of the stock's value, were not keeping up. Earnings for the 500 companies in the index had jumped 48% from the pandemic low, but were only 27% above the previous high profits, and stock prices were booming. That meant when trying to decide if stocks are a good value or expensive, using that price to earnings ratio, the PE value, stocks were getting terrifically expensive. By March of 2021, investors were paying almost $36 for every $1 in reported earnings for stocks in that index. That was more than 50% more expensive than the 10-year average valuation, a 50% premium on stock prices. As it always does when stocks get expensive, it made investors nervous, and when the Fed started raising interest rates and threatening those earnings, stocks plunged 25% from December 2021. And it is the same story we see time and time again. 2000, 2008, 2021, stocks boom, reach new highs, get ridiculously expensive, then any slight hiccup, and investors rush to the exits. So now, with stocks up 99% from the bare low of 2022 and up 29% in the last year alone, some investors are getting worried. Are stocks getting too expensive? And the answer, no. In fact, stocks just hit their cheapest point in 3 years, and the S&P 500 could go to 10,000, a further upside of 40% from here before it would start looking expensive. That's because in that bottom part of the valuation measure, the PE ratio, earnings are exploding. So far, Q1 earnings are up 27%, and analysts expect profits to keep a 20% pace of growth all year long to $325 in total earnings for those S&P 500 companies in the market index. That means if you take the market price, that S&P 500 index around 7150, and then divide by those earnings at 325, you get a price to earnings measure of just 22 times. That is only slightly above the 10-year average, and it's been a great place to buy stocks in the past. On top of that, earnings are expected up another 16% next year to $376 for the index. If investors don't start getting worried about stocks being too expensive until the valuation reaches a price of 28 times those earnings, so 28 times the 376 in forecasted 2027 profits, that takes the S&P 500 to over 10,500 in the next couple of years, another 47% return. And will there be hiccups along the way? Of course there will. We get a 5 to 10% correction nearly every year, and whether it's tariffs, a new war, or worries over AI, we will get the same over the next 2 years. But that trend is definitely your friend, and the market will move higher. Folks, that means staying invested, not keeping quite as much in cash, bonds, or other safety investments as you might, and maybe even tilting your portfolio to those higher momentum stocks like tech, beating the market with a 52% return over the last year alone. Now, I'll show you how this translates into the specific stocks I'm buying next, but if you haven't already, look for the special invite link in the description below and join me on the Blossom Investing app. Besides being able to see the stocks I'm buying in real time, you'll also join over 500,000 investors to see what everyone is talking about. It is totally free to download and helps support this channel, so I appreciate that, and it's a great way to get ideas and feedback on your stocks. Look for the special invite link I'll leave below or just scan the QR code here. As for the stocks to be watching through this bull market, shares of CCC Intelligent Solutions, ticker CCC, jumped almost 9% Thursday, the day after I recommended it as one of the software picks safe from the AI threat. I used research on software loans to find that vertical software makers have been sold off too far and highlighted 4 other stocks you do not want to miss. I'm going to leave a link to that video in the description, so check that out as well. I also highlighted cybersecurity stocks in that video and why I'm still buying shares of Palo Alto Networks, PANW, CrowdStrike Holdings, CRWD, Fortinet, FTNT, and Zscaler, ZS, on the rebound from those AI fears. And beyond those sold off software stocks, a bull market is going to mean that AI infrastructure stocks that we've been following are likely to continue higher. The four hyperscalers, that's Amazon, Alphabet, Meta, and Microsoft, the four biggest users and providers of cloud services, all raised their capital spending plans during earnings last week, which means over $700 billion in AI spending for data centers and everything that goes into them. And that's just these four companies. That means I'm still watching infrastructure stocks, names like Broadcom, AVGO, Marvell Technologies, MRVL, and NVIDIA, NVDA. Now looking at the stocks I'm watching this week, it is a huge earnings week. First up with Advanced Micro Devices, ticker AMD. We're going to be reporting earnings on Tuesday with the stock up 192% from when I started buying last year. I've got to be honest here, I actually chickened out and started selling this year, selling the rest of my position just last month for a $406,000 gain, an average selling price of over $270 per share. So I did miss out on some of that upside, but just couldn't see how the valuation wasn't getting stretched here. Yes, sales are expected to boom 35% this year and 45% next, and the company has done an amazing job boosting its profitability to produce that 61% increase in forecasted earnings. But Nation, we started buying AMD at just 6 times on a price to sales valuation. Now, it's almost 16 times that valuation. Even adjusted for that growth, that is expensive, and I'd rather take those profits, risk losing out on a little bit more upside than watch it drop on any bad news. Now, going into earnings on Tuesday, it hasn't had a good track record, falling in 2 of the last 4 reports and plunging by 17% on last quarter's release. Arista Networks, ticker ANET, also reports earnings on Tuesday, with the stock up 174% since recommending it last year. That shortage in AI networking equipment, but this is another one making me a little itchy on those earnings. The company is expected to post 30% revenue growth for the quarter, just a little above the full year pace, and 24% earnings growth. But that valuation has also gotten stretched to almost 49 times this year's earnings forecast. Everything we've heard from the other AI infrastructure stocks has been good, and Arista has done a passable job in the past earnings calls, rising in 2 while falling in the other 2 over the last year. Investor sentiment is still strong on this one, so even if it did fall, I think investors are going to buy back in and support it longer term, so I'd hold on through any bumps here. Super Microcomputer, ticker SMCI, is going to be the big news for my portfolio when it reports earnings on Tuesday, with investors watching for any sign that rumors around server deals are being canceled. Honestly, I think it's a little more than suspect that the recent short seller dropped their news during that company's quiet period over the last 2 weeks, that 2-week period before earnings release that management usually doesn't give any public releases. Analyst forecasts for earnings haven't budged on the news, with no profit downgrades for the quarter and only a 1-cent hit to the next quarter forecast. So if management can confirm that full-year outlook, still for 88% revenue growth to $41 billion and around $2.25 per share, the stocks should do very well for the day. Of course, SMCI is no stranger to big moves on its earnings, shooting higher 14% last quarter, but also falling double digits in the prior 2 reports. The options market is expecting a 10% move either way, and options premiums are through the roof with this volatility. So if you're worried about this one, then you can hedge quite a bit of your risk with selling some call options. Fortinet, ticker FTNT, reports earnings on Wednesday, with the stock still off from last year's plunge on its Q2 earnings. The stock's dropped 22% on that report and has finished lower in 3 of the last 4 reporting days. Now, this year's fear that AI is going to replace cybersecurity software hasn't helped the stock much, but those shares remain at one of my favorites in the space. Growth is slower at just 11%, but it's one of the most efficient in the industry, with a 32% operating margin. It's forecast to almost $3 per share earnings this year. That puts it at just 8 times on a price to this year's forecasted sales and 28 times its earnings, both steep discounts to what investors have paid in the past. So I'm going to continue to hold on for that long-term cybersecurity story. Symbotic, ticker SYM, also reports earnings on Wednesday, with the shares down from their $83 peak, but still up 155% from when I started buying, and still a good long-term growth story. Investors are worried that growth is slowing and there's a lack of any big news, but the Walmart partnership on robotics and warehouse automation is locked in, and the SoftBank tie-up takes this one international. Forecasted growth is still good at 23% this year, though earnings are taking a hit as the company reinvests, so I'll be watching for any guidance on profitability. Management has done a very good job at managing those expectations in the past, with the shares up 39% after its Q4 earnings report last year. Going off options pricing, the market is expecting a giant 15% move on earnings, so This could be a big one if it goes well. SoundHound AI, ticker SOUN, reports earnings on Thursday with the shares down 57% off last year's peak, but up a giant 20% Friday on a short squeeze into earnings. The stock has been hit on multiple factors, but is still a good company and a great bet on the agentic AI story, with the voice assistant market a $160 billion opportunity. Revenue growth has slowed to 37% a year, which is still really good, but just not the 80% plus that we got used to. The move last week seems to be in connection with the company's newly announced acquisition of LivePerson, which management says could boost total revenue to as much as $400 million next year. That would be a return to 70% growth and send the short sellers running for the exits. Now, this could be one of the most volatile stocks of the week, with the options market pricing in a 10% move, and investors hoping it's like the Q2 report last year that saw the stock up 26% on the day. An update here to SoFi Technologies, SOFI, which got crushed 16% last week on its earnings, and I'm back in the stock with 6,000 shares after taking profits late last year. Revenue and user growth was still extremely good, with sales up 43% and adding 1.1 million users just in the quarter. But investors were worried about the outlook and the continued weakness in its B2B tech platform. I outlined why I'm buying again in Friday's video, detailing the double-digit upside and a potential for a surprise announcement this year. Updating our stock market outlook, it is a slow week for economic data until we get the Friday's jobs report, but earnings season is still in full swing and has been very, very good. Profit growth of 27% for companies in the S&P 500 has boosted stocks to new highs and the strongest April return in 6 years. Now, that strength in the overall market has hidden some surprising returns and opportunities in individual sectors and the stocks in them. And here we can use the State Street Sector Tracker to dig into the trends for this year. It's no surprise that stocks in the energy sector are the standout performers, up 33% year to date against a 5% return on the broader index, but I wonder how much further this has to go. The price of oil seems topped out around $100 to $110 per barrel WTI, that's West Texas Intermediate, and both sides are highly motivated to come to some kind of negotiations. And we're right now at a standstill on the Strait blockade, and experts say Iran could have as much as 2 months before storage is full, so both sides has that bargaining leverage, but are motivated to end the war. Stocks in the materials and industrial sector have done very well as well on general economic growth, with those sectors up 13% year to date. Within industrials, it's been those power generation stocks that have rocketed higher on that data center buildout, with Vertiv Holdings, ticker VRT, doubling in the first 4 months alone, followed by Generac Holdings, ticker GNRC, Quanta Services, PWR, and GE Vernova, ticker GEV. And for all the attention they get, tech stocks have only grown about 10% so far this year. And that's still twice the market return, but only the fourth best sector. Within tech, it's been the memory hardware producers surging on that bottleneck for hard drive capacity, with SanDisk, ticker SNDK, up 360%, followed by Western Digital, WDC, and Seagate Technology, STX. But we did start to see cracks in that story late last week when both SanDisk and WDC fell sharply on their earnings. The stocks recovered later in the day, but were down as much as 8% lower pre-market against those valuation concerns. Then real estate stocks have been the big winners nobody is talking about, up 10% so far this year, but with lots of room to run. The 31 real estate investment trusts, those REITs, so companies holding the commercial property and renting it out in that sector, only up 4% over the last 5 years, after a brutal 2022. But investors are slowly coming back, and commercial property prices are getting a bid from institutional investors, fleeing that private credit scare. With its deep value and inflation hedge, property is making a comeback, especially in the data center stocks like Equinix, ticker EQIX, up 41%, Digital Realty Trust, ticker DLR, up 29% this year. As that demand for data centers continues, but communities fight new construction, those existing centers owned by these two REITs are going to become more valuable, and they will be able to increase rents. On the weaker side of the market, and something we'll be following very closely, stocks in the consumer sector as well as financials have underperformed this year. This is more important than most investors realize and could bring the rest of the market lower if the factors here get worse. Consumers are getting stretched by inflation and limiting their spending, a trend that could affect the economy and the rest of the market, as consumer spending is 70% of the economy. We're also seeing loan defaults rise, which is why those stocks in the financials are falling, another trend that could get worse and could affect the broader market story. Right now, that earnings momentum and the fact that stocks are very cheap is supporting stocks and should keep that momentum going higher, but Be sure to watch the inflation picture, Iran, and the jobs market over the next few months. In the meantime, join me on the Blossom Investing app with the link below. See what over 500,000 investors are talking about. If you want to see more of my favorite stocks, check out the playlist here, The Best Stocks in 2026.